AI-driven equities are pushing toward a rare 10-week winning streak, just as oil supply shocks and renewed inflation risks drag bond yields higher. For allocators, that collision between powerful growth stories and tightening financial conditions is forcing hard choices across every major asset class. Welcome to vTalkInsight, Allocator's Lens Daily for June 2nd, 2026. In equities, the core story is still relentless AI-driven earnings strength set against increasingly late-cycle risk signals. U.S. growth is projected to accelerate toward roughly 4%, unusually strong for a mature economy. And that backdrop is giving investors confidence that AI-heavy indices can sustain gains over the next couple of years. We see that in price action. The S&P 500 is on the verge of a 10th straight weekly advance, and an index of AI winners is up far more than the broader benchmark year to date. Under the surface, earnings delivery has been exceptional. First quarter profits for the S&P 500 came in well ahead of expectations, and simply capitalizing that surprise at a 20 times multiple implies several hundred points of potential index upside if momentum persists. Chipmakers and hardware suppliers tied to AI infrastructure are reporting around 25% profit growth, and guidance from the hyperscalers points to robust capital spending on data centers through at least the middle of the decade. Importantly, the AI theme is broadening beyond a handful of megacaps into industrials and commodity producers supplying the build-out, including heavy equipment, aluminum and copper names, and a growing cohort of Asian memory and supply chain stocks. The flip side is how narrow that strength has become. Technology now makes up close to half of the S&P 500, and AI-related stocks account for the vast majority of gains in both U.S. and emerging market indices. Only about half of index constituents trade above their 50-day averages, and some markets, like South Korea, have effectively doubled this year on AI momentum alone, all of which raises classic concentration and crowding concerns. Options activity is amplifying that late-stage feel. Call buying is running at historic levels across a wide range of stocks, not just the old meme names, and skew has flipped in more than 70 S&P 500 constituents, with upside demand outpacing downside protection. That pattern, combined with the VIX sitting in the mid-teens, even as the index grinds higher, suggests realized risk may be underpriced and that volatility is being expressed through speculation rather than hedging. There are also clear catalysts that could test this optimism. The calendar of upcoming AI and space-related listings is heavy, with one prospective deal set to be the largest IPO in history and an unusually large slice earmarked for retail buyers. Several commentators expect a meaningful drawdown between June and October as those deals absorb liquidity, interact with Fed policy uncertainty, and collide with typical pre-election seasonality. On top of that, history suggests that sharp moves in long-term yields, particularly if 10-year rates approach the 5% area, often act as the pin for equity bubbles. Yet the structural AI story remains powerful. Some forecasters now argue that AI capital spending could add roughly twice as much to global GDP as higher oil prices subtract, and sell-side equity targets have been lifted toward the high 7,000 area for the S&P 500 on the back of that thesis. Valuation is not uniformly stretched either, with selected memory names still trading on mid to high single-digit earnings multiples if the cycle lasts. For multi-asset allocators, the balance of evidence is an equity market supported by real earnings and capex, but heavily reliant on a narrow group of AI champions, increasingly enthusiastic options positioning, and benign financing conditions. The key watch points are upcoming inflation and labor prints, the path of long yields, and how the mega IPO pipeline interacts with indices. Those same forces are now front and center in rates. In rates, the narrative has flipped from imminent cuts to a serious debate about renewed tightening. Over just a couple of months, markets have moved from expecting several reductions in policy rates to pricing in the possibility of at least one hike this year. Fed officials have become more vocal about persistent inflation risks and are clearly less worried about employment, which reinforces the sense that policy is likely to stay on hold at elevated levels unless inflation cooperates. Market pricing reflects that shift. The 10-year Treasury yield has pushed back above 4.5%, and spread between 5 and 30-year maturities have flattened to their tightest levels in about a year. That combination signals tighter expected policy over time, and for some, an improving risk-reward profile in longer-dated bonds compared with where they stood when the curve was steeper. At the same time, high energy prices and ongoing fiscal deficits raise the risk that term premiums continue to drift higher, especially if inflation data surprise to the upside. At the front end, yields remain elevated and already incorporate the idea that AI-related investment and government spending are inflationary in the near term. Commentary highlights that short maturity paper offers attractive carry with limited exposure to further rate hikes, particularly while energy-related price pressures linger. Interestingly, rate volatility is much lower than during previous tightening scares, with key volatility indices peaking well below the extreme levels seen in earlier cycles. That relative calm has helped limit the damage to equity valuations despite the move higher in yields. Looking ahead, markets see an increasingly binary inflation path, with outcomes clustering around a clean return toward 2% or a drift above 3%. If upcoming inflation and jobs data lean toward the higher path, expectations for additional Fed tightening are likely to intensify, which would test duration-sensitive assets and highly valued growth stocks. If instead the data allow the Fed to stay on pause, the higher-for-longer regime may remain a manageable headwind rather than a shock. Either way, the rates backdrop is now a central input into credit and currency dynamics. Corporate credit still looks remarkably robust on the surface. Spreads remain tight and new issuance is being absorbed readily, even after a heavy supply calendar so far this year. Large technology and AI-related firms are financing themselves across both public and private channels, with recent sizable private placements underscoring how deep demand for high-quality tech paper remains. The risk is that this strength leaves little cushion if conditions turn. Spreads at or near cycle tights offer limited compensation for a scenario where long-term yields rise further or a growth scare hits earnings. There is also a growing overlap between mega-cap tech names in both equity and credit indices, which reduces the effectiveness of traditional stock versus bond hedges for portfolios concentrated in those issuers. Beneath the investment-grade surface, stress signals are more visible. Retail capital has poured into private credit vehicles that promise yield and access to corporate lending, but redemption requests are picking up, raising questions about liquidity mismatches and whether end investors fully understand the underlying risks. At the same time, a significant share of lower-income U.S. households is turning to payday lenders and other shadow finance providers, which means bank credit statistics may no longer be reliable early warnings for consumer health. Combined with rising interconnectedness between private credit funds and banks, that creates potential fragility points if there is a macro or market shock. Those credit undercurrents interact closely with currency moves. FX markets are digesting the same mix of strong U.S. growth and uncertain inflation, but with an additional lens on currency translation. Many overseas investors remain wary after last year's dollar weakness eroded what looked like strong U.S. equity gains in local terms. Concerns about persistent inflation and large budget deficits feed into debates about the dollar's longer-term role, even as its depth and liquidity keep it central to global portfolios today. The Japanese yen stands out as a focal point. It is under renewed pressure, trading near 160 against the dollar, which is increasing expectations that the Bank of Japan will eventually have to tighten policy more decisively to address imported inflation and currency weakness. A shift from the Bank of Japan, particularly if it coincides with a Federal Reserve that is still on hold or even hiking, could reshape popular funding and carry trades and alter hedging costs for global investors. On the fringes of FX, demand for new onshore instruments linked to crypto assets such as Bitcoin is strong among both institutional and retail participants. These products extend leveraged, around-the-clock exposure to highly volatile assets, effectively adding another layer of optionality and risk taking on top of already buoyant equity and credit markets. Any sharp shift in broader risk sentiment could see that leverage act as an amplifier, feeding back into more traditional currencies as positions are unwound. Energy markets are the other major channel through which macro risks express themselves. Commodities, and oil in particular, now sit at the heart of the macro regime. Disruptions around the Strait of Hormuz have effectively removed roughly 1 billion barrels from global supply over the past few months, and clearing the backlog of ships while restoring safe passage could take many more. Inventories are falling, June and July are seen as critical months for balances, and some Asian markets are already reporting rationing and demand-side adjustments, all of which point to tight near-term conditions. The geopolitical backdrop remains highly unstable. Negotiations between the U.S. and Iran are dragging on with little progress on core issues such as nuclear activity, control of Hormuz, and regional conflicts in Lebanon. Iran has demonstrated that it can disrupt shipping using relatively low-cost tactics, increasing its leverage and making any return to the previous status quo both costly and uncertain. Even if a partial agreement reopens the strait, deep internal and regional opposition suggests any settlement would be fragile, leaving a persistent risk premium in energy markets. Price action reflects that push and pull between optimism and risk. Oil recently dropped by double digits on hopes of a breakthrough, only to rebound sharply as communications deteriorated and clashes escalated, with one move seeing U.S. crude jump more than 6% in short order. Equity markets have been surprisingly resilient, with energy shares outperforming and AI-heavy indices continuing to climb despite higher input costs and yields. But if elevated oil prices persist, they are likely to lift inflation expectations, pressure central banks toward tighter policy, and weigh on rate-sensitive sectors and lower-income consumers. Beyond oil, deglobalization is fragmenting commodity markets and shifting influence toward emerging producers in the Middle East and elsewhere. Disruptions to key trade routes are causing volatility not just in crude, but also in niche inputs like helium and fertilizers, reinforcing the inflationary tilt of the regime. AI and data center build-outs are adding a structural layer of demand for electricity and fuels, helping the energy sector regain prominence in global portfolios after years of underweighting. Even gold is behaving differently, with its volatility now more than twice that of the S&P 500, signaling that it is trading as much as a speculative asset as a safe haven. For allocators, commodities have shifted from quiet diversifiers to active drivers of macro and cross-asset risk. Pulling it all together, today's cross-asset picture is one of powerful AI-driven earnings and strong growth expectations colliding with a higher-for-longer rate backdrop, tight credit spreads, fragile FX dynamics, and a highly uncertain energy supply environment. Equities continue to climb on the back of exceptional tech and semiconductor profits, but leadership is narrow, options activity points to growing exuberance, and valuations are increasingly sensitive to long-term yields. Rates markets now price a meaningful chance of renewed Fed tightening if inflation and wage data fail to improve, even as volatility stays subdued and curves flatten. Credit remains open and supportive for high-quality borrowers, while stress is building in private credit channels and among lower-income households who sit outside traditional bank statistics. FX expresses these tensions through a pressured yen, a still pivotal dollar, and growing leverage in crypto-linked products, and commodities tie the macro story together as Hormuz disruptions, deglobalization, and AI-driven power demand keep oil and broader inputs central to the inflation debate. For multi-asset allocators, the key is to watch how upcoming inflation releases, labor data, oil supply developments, and the IPO calendar interact across these asset classes to either validate the current risk on regime or force a repricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.